Hey everybody, this is Ryan Mallory with Swing Trading the Stock Market. In today's episode, we're going to talk about the top-down trading strategy. It's a very in-depth topic. It's not really something that I can cover all in just one podcast or even really do that without going into a lot of visuals. So I'm going to give you more of a general understanding of it so that you can apply it to your own trading. But the email that I got today, and for those who are new to the podcast, I do email Q&As every week. I take one person's email and I make a whole podcast episode out of it. And so you can also do the same by sending me an email to ryan@shareplanner.com. I do read them all and I do try to make a podcast episode out of each and every one of them. As long as it's a valid question, more than likely it'll get a podcast episode. So make sure to keep sending those to me. So for this episode, I'm going to give a Florida redneck name to this guy who emailed me, this gentleman, and it's going to be Bud. Bud, good old Florida redneck name, writes, "Hey Ryan, do you think that you could do an episode going more in depth on your top-down trading strategy? When you are checking the overall market or sector performance, are you just looking at it for that day or for that week? I've been using FinViz to look at all the sectors, and I'm just trying to get more of a clear understanding of how you apply the top-down approach. Also, can you tell me how you find out the information on the industries within those sectors? I really appreciate the episode that you did about the stop-loss management on my Google trade a few weeks ago. I've been taking partial profits, and it has made a huge impact on the emotions and on the profits as well. I'm still loving your Patreon, and you have made a good number of profitable trades from there. I also think I must be doing something right because quite a bit of the stocks that I've been picking out when screening have been put on your Patreon as well. Thank you for everything that you have done, and have a good day. Thank you, Bud." All right, so good email. He also writes here too, he followed up with another email, so I might as well read that as well. Also, I forgot to ask you something. When you're drawing trend lines and looking for patterns, do you use candle bodies or candle wicks? Thank you. All right, so I'm going to work my way a little bit backwards here. I'm going to talk about the candle wicks first because I think that's kind of an easy question. And like a typical economist, which I'm not necessarily an economist, I studied economics in college, but I always use the famous response of, it depends. And the reason why I say that is when I'm drawing trend lines, what I'm really looking for is a level of consistency where a stock bounces off of a key support line that's rising. And that can also go with price level supports that just go straight horizontal. So sometimes it'll incorporate just the body. Sometimes it'll incorporate perfectly the lower shadows on the trend lines. Or if it's a declining, it'll incorporate the upper shadows of the candlesticks. But the reason why I say it depends is because it's not all that common to find perfect trend lines to where it just touches that trend line perfectly and goes right back up. Oftentimes there's a little bit of an intraday break, but what I like to find is that where is that consistency at? Where is the level that the stock consistently bounces at? So oftentimes there's a mix of where the trend line's going through just the lower part of the body. When it's a rising trend line, it's going through the body, it's connecting the lower bodies of the trend lines, and it's may have some candle wicks that are going down below, and then there's also parts of that trend line that might just see price bounce off of it at an intraday low and bounce back up. And so without making it too confusing, when I'm drawing trend lines, the takeaway here is to remember that when you're drawing the trend lines, it's okay for it not to be perfect because rarely in technical analysis is anything perfect. And that means that if you're looking for perfection, you're going to pass up on a lot of good trade setups because you made the perfect setup the enemy of the great setup. So again, when you're drawing trend lines, you're trying to connect as many data points as possible. That doesn't mean that you just let price action just run roughshod all over the trend line, go way below and then pop back up. But it does mean that it's okay if there's some intraday breaks below it as long as it can recapture it into the close. So as long as the closing price is above the trend line, that is what I'm looking for most oftentimes. Now, the top-down trading strategy, and I get a lot of questions on this. I do a lot of private coaching on it as well, and it's pretty in-depth. So what I'm going to do here is give you a more of a general understanding and try to answer some of the key questions that you had here. Top-down trading strategy is essentially stacking the variables in your favor for when you're making a trade. Oftentimes, people just look at the individual trade setup and say, hey, this stock, ABC, looks really good. I'm going to go ahead and make a trade on this stock. Not even considering what the overall market's doing, what sector is rallying, what sectors are not rallying. It may not be that stock sector that's rallying. It may be in a deep sell-off and it just hasn't caught up with its own sector yet, and it may be happening later in the day after you get into the trade. It also means that they're not considering the industry that their stock is in. And so there's 11 sectors. There's about 148 industries that I track within those 11 sectors. So what I want is I want the stock that I'm trading to be in alignment with the industries, the sectors, and the overall market direction. If any of those are not in balance with each other, then I don't want to make those trades. So what I'm trying to do is stack the odds for success on a given trade setup as much my favor as possible by making sure all of these areas are in alignment with one another. So if I like the stock ABC and the industry and the sector is doing really good, but the overall market is trending lower, that's going to be a reason for me not to get into the trade. And if stock ABC looks really good and the overall market looks really good, but the sector that it's trading in looks awful, I'm not going to get into it either. So again, I need all of those variables in alignment with each other. Now, there may be times where, and this does happen quite a bit, where the overall market, the sector, the industry, they're all in alignment with each other. And then I go to try to find a stock that will reflect what I'm seeing in the overall market, sector, and industry, and I can't. I just can't find a good stock. Sometimes it's just all of them are overbought, or some of them are just not providing a good reward risk ratio. So that happens too. And so it's important for me to keep tabs on what sectors are rallying, what sectors are doing really good, and then which industries within those sectors are doing good too. Like I said, there's 11 sectors. That's going to be materials, XLB, and I'm going to read them off just in case you don't know them. You can write them down as I'm reading them. The first one, like I said, materials, XLB. The next one's communications, XLC. The next one, energy, XLE. Financials, XLF. You see the trend here? They oftentimes start with the letter that the sector starts with. Not all of them, but some of them do. Industrials is XLI. Then you got technology, which is XLK. Then you have, what is the next one? Staples, XLP. That's one that does not start with an S. And then you have utilities, XLU. You have real estate, XLRE. Then there's healthcare, XLV, discretionary, XLY. Let's see, did I forget any? I don't think I did. I said utilities, healthcare, XLV. Yeah, got them all. So those are your 11 sectors. Within those 11 sectors, there's about 140 or so industries that I track. For instance, like in technology, you have software, you have semis, you have electronic components, you have internet companies. The list goes on and on. Industrials, you can have defense companies, you can have farm equipment. You can have, there's just a myriad of different ones. Then in industrials, discretionary retail stores, you can have auto companies. You get the picture. So when I'm looking at the overall market and it's trending higher, and then I'm looking at technology and I'm seeing that there's a good setup there within the tech sector, it looks like it's about to explode higher. And then I'm looking for which sectors within the tech sector are rallying, and maybe I find that it's semiconductors. And then I'm looking at stocks like NVIDIA, AMD, ON, LRCX, KLAC. I'm just going down the list and trying to find the one that offers up the best trade setup. So one of the things about the top-down trading strategy is that it can oftentimes, when the market is not in your favor and there's not sectors that are in alignment with the market, it can lead to periods of inactivity, especially if you're a long-only trader. That's okay. A lot of people find that that's a bad thing, but it's not, because the flip side is the down-top strategy, where essentially you're just looking for stock picks. You're looking for stock picks like an addict looks for its next hit. So you don't want to do that, because oftentimes you're getting into trade setups that are not favorable, not because the trade setup's not favorable, but because of conditions that you're not even paying attention to, meaning the industry, the sector, and the overall market direction. But it can also help narrow your choices too. I find this has helped me a lot at times when I'm like, I got like 10 really good trade setups here, and I don't know which one to take. And I look at them and it's like, I'd like to take all 10 of them, but I'm only going to take like one or two of them. And so what I'll start doing is I'll look at the sectors that are doing the best, and then the industries. And so then I'm going to want to find that trade setup out of those 10 trade setups that I have that matches the best with the overall market direction, the sectors that are the hottest, the industries that are hottest. And then I can usually narrow it down from 10 down to like one or two very quickly. And something else that's really worth checking out, swingtradingthestockmarket.com. Yes, that is my Patreon account that goes along side by side with this podcast. And if you're listening to it on YouTube, it goes alongside of my YouTube channel. You can just click join on YouTube, or you can go to swingtradingthestockmarket.com and support it via the Patreon account. Either way, you're going to get my weekly watch list of master bullish and bearish watch lists that I do each week. You're also going to get my daily watch list of stocks that are showing the most promise for that particular day, plus videos of some of the best trade ideas that I can come across. Then you have updates on the tech sector and on the S&P 500. Most of them are done via video, so it's really good. It's a huge addition to listening to this podcast and a way to support the podcast as well. So check that out, swingtradingthestockmarket.com, or just click join below if you're watching this on YouTube. Okay, now that I'm done with that plug, let's keep digging in a little bit further here. So what I want to do now is give you a couple of examples. And I'm not pulling up charts because Ideally, you're probably listening to this on the way home from work and you've had a stressful day, and the last thing you need is like some visuals to throw up there. So I try to make it as easy as possible to explain. Right now, you have had the S&P 500. It's been on a 2-day pullback. So the market has pulled back 2 straight days. I don't know if it's going to bounce the next day yet. It could. History over the last 3-4 months suggests that there's a very good chance of that. It is overbought. So I'm in this wait and see mode. Meanwhile, I've also noticed that the industrial sector is looking pretty good as well. The industrial sector has pulled back to a key price level. It's a key support where it previously broke out at. So what I'm watching for there is, does the industrials break out? Because I could go into technology, I could go into that sector, but what am I dealing with tech and with discretionary and with communications? I'm dealing with very, very overbought conditions. Yes, it could keep going higher and higher. We just saw Tesla go up another 5% today. But does that make that an ideal trade scenario when there's no edge to find the risk underneath the trade setup in case the stock trade does go wrong? And the problem with chasing after some of these trades that is just pure FOMO driven is that there's no way to really manage the risk in a very tight and productive manner. Instead of getting into a trade where you're hoping for like a 3-to-1 return, you might be only getting into a trade setup that's like 0.5-to-1 or 1-to-1 from a reward risk standpoint. So as a result, I start looking in other sectors that are still setting up to the long side, but are providing me with good reward risk ratio. So I start to notice that industrials is setting up pretty well. And then within the industrials, I noticed that diversified industrials is also in a pretty good breakout mode right now. So now I've identified the market direction. It's pulling back a little bit. Not quite sure that I want to go ahead and just jump into it just yet. I want to wait to see if it can bounce. In alignment with the overall market, you have the industrials pulling back over the last 2 days to a key support level. And now I want to see if that can bounce. And then I've noticed that diversified industrials has been on a pretty good bullish tariff rate. So now I've got all three areas working in my favor. So now I need to go find a stock within diversified industrials that provides a good quality reward risk ratio. And I find that with Honeywell, HON. Honeywell has had a cup and handle breakout. Now it's been pulling back over the last couple of days, and it's showing the potential for a bounce higher. So that's how the top-down trading strategy works in real time. Now, does it take me a long time to go through all that stuff? No, because each day I'm evaluating the market. So without even having to go back and look at the market, I usually know which sectors are already setting up. Like right now, I could tell you industrials are setting up. I could tell you that real estate has a double bottom and materials has a double bottom, that they're both trying to create a potential breakout scenario for. I know that technology, discretionary communications, they're kind of crazy. They're a little bit overextended. Healthcare hasn't really gone anywhere. Utilities hasn't gone anywhere. They're both trading sideways. Financials, I mean, it's really hard to trust the financials right now with all the regional banks in such dire crisis. And really, if you look at Citigroup and JP Morgan and some of these others, they haven't really moved all that much. That provides a good opportunity going forward. And staples, kind of sideways as well. So that leaves me with industrials. Oh, and we forgot about energy. Energy looks like it might be starting to roll over. Yes, it's on this nice rising trend line, but it's not putting in higher highs. It's actually putting in lower highs and creating just a massive triangle that looks like it's on the verge of breaking to the downside. So I don't want to touch energy right now. So again, that leaves me with industrials, materials, real estate. That's what I'm really looking at this point using the top-down trading strategy. So let's talk about materials. Let's look at the S&P 500. We've talked about it's in the middle of a 2-day pullback. Not anything serious, not anything, panicky or, emotion driven. It's just kind of a systematic pullback after a pretty crazy run higher. Then you have materials. It's forming, like I said, a double bottom, but it hasn't broken out yet. In fact, it actually had a pretty significant amount of selling today, and it hasn't broken out yet. But you get a couple days to the upside, pretty good couple of days of buying. Yeah, I could see where it could actually break out. And then I come across this FCX stock. And a lot of you guys have probably heard it. It has a downtrend, hasn't quite broken out of it yet. But then let's go look at the industry that it's in. The industry that it's in is copper. And copper kind of looks iffy. It's had a pretty good rally since the May lows were established in late May. And it's been on a tear since then. But I want to be careful. I want to make sure that it doesn't take a significant pullback here, because if the market can find its footing and start to rally and materials can also rally, I want to make sure that copper is also following suit before I jump into FCX. So copper isn't as bullish right now in 2023 as some of the other sectors that we've been talking about. And I'm not so sure that just because the material sector rallies that copper will follow with it. It's just like with gold. You could have a big breakout of materials And you think, oh my gosh, materials are looking really good. I'm going to start getting into some gold miners because that's part of materials. And then as materials is running higher, as the market's running higher, and as the materials sector is running higher, and as the overall market's running higher, your gold miners are actually selling off. And you're like, what the heck is going on here? And it's because not all the industries, particularly in materials, always runs with the sector. Sometimes it's just one or two specific sectors that are right. It might be chemicals. And because oftentimes chemicals can rally all of materials while leaving a lot of your precious metals behind. So that is the top-down trading strategy in a nutshell. I didn't go into too much depth there. I just kind of gave you a cursory understanding of it, but it's very effective. It takes a lot of patience. It takes a lot of discipline because oftentimes you will come across a stock that looks really, really good on paper, man. It's like it's got the perfect reward-risk ratio. It's like, man, I just know this thing's going to break out to the upside. But you don't have a market that says, hey, this is a good time to be getting long. And so anyways, you ignore the overall market trend, you get long, and then all of a sudden you find yourself just getting destroyed because the market keeps sinking lower and it pulls down that stock with it. And if you had just been more cognizant of overall market direction or sector direction, you could have avoided that whole bad trade setup to begin with. If you enjoyed this podcast episode, I would encourage you to like and subscribe on YouTube, on Spotify. Leave me a 5-star review. I really appreciate those things. Tell me down in the comments below on YouTube here, what trading strategy do you like? Do you use a top-down trading strategy? Do you use a different one? I want to hear all about it. And keep sending me your emails, Ryan@SharePlanner.com. I would love to hear from you guys. Check out swingtradingthestockmarket.com. Thank you guys, and God bless. Thanks for listening to my podcast, Swing Trading the Stock Market. I'd like to encourage you to join me in the SharePlanner trading block, where I navigate the stock market each day with traders from around the world. With your membership, you will get a 7-day trial and access to my trading room, including alerts via text, email, and WhatsApp. So go ahead, sign up by going to shareplanner.com/trading block. That's www.shareplanner.com/trading block. And follow me on SharePlanner's Twitter, Instagram, and Facebook, where I provide unique market and trading information every day. If you have any questions, please feel free to email me at ryan@shareplanner.com. All the best to you, and I look forward to trading with you soon.